In August of 2025, the Consumer Federation of America and the Climate and Community Institute ran 608,105 test quotes for homeowners insurance in every state except California, Massachusetts, and Maryland. 157 variables stayed frozen across every single quote. Same house, same street, same roof, same wiring, same distance to the fire station. The only thing that moved was the homeowner's credit. When the results came back, the average gap stood at $1,996 a year. Here is the part that lands harder. Across many of those quotes, the credit penalty outweighed the cost of living in a wildfire or hurricane zone. A homeowner with weak credit in a quiet, low-risk suburb can pay more to insure his house than a homeowner with strong credit on a coastline that floods. Not because his house carries more risk, but because a number attached to him says he does. Most homeowners have never laid eyes on that number. It is not the FICO score a lender pulls for a mortgage. It is a separate score, calculated differently, sold to insurers for one purpose: predicting how likely a policyholder is to file a claim. For more than 3 decades, that score has been baked into homeowners' pricing in roughly 47 states, and the trail behind it leads to one company, one product, and 1 year, 1993. So the question is not whether your premium reflects your house. In 47 states, it measurably does not. The real question is how a measure of your bill-paying behavior became a rating factor on your roof, and who signed off on it. The entire premise of homeowners insurance is that the premium prices the property, the age of the roof, the wiring, the plumbing, the claims history on that address, the distance to the nearest fire department. That is what the inspection measures, what the application asks about, and what most policyholders believe they are paying for. Then a second number slipped into the rating plan, and almost nobody was told. That number carries the name credit-based insurance score, and it is not the FICO score a lender pulls for a mortgage. Built as a separately branded product, it draws from the same credit report data, but weights it to predict something entirely different. The question is not whether you will repay a loan. The question is whether you will file a claim. FICO's version of the insurance score runs from 250 to 900. LexisNexis sells one scaled from 300 to 950, and TransUnion's runs from 150 to 900. Most consumers have never seen any of them, and most assume they are the same credit score they already know. They are not. Today, in states where the practice is permitted, an estimated 85% of homeowners insurers and 95% of auto insurers use these scores to help set what you pay. The legal authority behind all of this is older than the score itself. Congress passed the Fair Credit Reporting Act in 1970, and buried inside that statute sat a provision permitting insurers to use credit information in underwriting and rating. For 23 years, that permission mostly sat dormant, a legal door left unlocked with no instrument built to walk through it. And the regulatory structure guarding that door was never one gate. It was 50. Insurance rates in America win approval state by state, commissioner by commissioner, which meant there was never a federal review of credit-based pricing, never a national hearing, never a single approval a consumer could point to. It also meant there was never a single place to object. The rules inside those states carry a distinction worth sitting with. In most states, an insurer cannot deny coverage solely because of credit. The insurer can, however, price the coverage on it. A homeowner quoted a premium he cannot afford has, in practical terms, been denied, while every party involved stays technically compliant. By the early 1990s, the pieces sat in place. A 1970 federal permission, 50 separate state gates with no coordinated review, and an industry holding a direct profit motive, because any variable that predicts claims more precisely protects margins and keeps the lowest risk customers from subsidizing everyone else. The only thing missing was the instrument. In 1993, a company in San Rafael, California, built it. That company was Fair Isaac Corporation, the same firm that had launched the first general-purpose FICO credit score 4 years earlier, in 1989. In 1993, Fair Isaac introduced a purpose-built model it called the credit-based insurance score. The construction was direct. Fair Isaac pooled policy records from more than a dozen insurance companies, over 1.4 million policies representing more than $1.5 billion in earned premium and nearly $900 million in incurred losses, then matched those records against the same policyholders' credit reports. What came out was a statistical correlation. People who manage credit obligations a certain way file claims at measurably different rates. No causal mechanism was required. The correlation alone was the product. No named inventor appears anywhere in the record. No patent number and no internal memo has ever surfaced. What the record does show is the commercial result. Fair Isaac's annual sales stood at $42 million in 1992, and by 1993, the year the insurance score went to market, sales reached nearly $67 million. Approval arrived the same way objection never could, diffusely. Through the 1990s, state insurance commissioners permitted the score as a rating variable state by state, most of them tacitly, by never disapproving it. There was no vote, no signing ceremony, no headline. Today, only California, Massachusetts, and Maryland ban the practice for homeowners insurance, which leaves roughly 47 states permitting it. Washington state, at least, made the arrangement visible. House Bill 2727, passed 94-0 in 2004, required every insurer using a credit-based rating plan to file the model with the state insurance commissioner. Confirmation that this operates as a formal, regulator-approved actuarial instrument. The federal government looked at it exactly once. Under the Fair and Accurate Credit Transactions Act of 2003, Congress ordered the Federal Trade Commission to study the practice, and in July of 2007, the Commission reported back on the auto insurance market, though the scoring mechanism for homeowners is identical. The scores do predict claims, and predict them even within racial and ethnic groups. The same report found that over half of African American consumers fell in the lowest quarter of the score distribution, and the Commission stated it had tried and failed to build an alternative model that kept the predictive power while narrowing that gap. The practice continued. What makes the state map harder to dismiss is California. The one large state where credit never entered auto insurance pricing blocked it in 1988 when voters passed Proposition 103, 5 years before the insurance score existed. California never evaluated the 1993 model and rejected it. California was simply, by accident of timing, already closed. The mechanism is still running, and the meter is specific. $1,996 a year is the average homeowner's penalty in the Consumer Federation study. In Oklahoma, the raw gap reaches $4,138. In Pennsylvania, the penalty runs 181%. Norma Garcia, a senior staff attorney at Consumers Union, put the objection in one sentence back in 2007. Insurance premiums should be based on the risk of an accident, not a consumer's bill paying record for other goods and services. 19 years later, in 47 states, the bill paying record is still in the premium. The 1993 architecture is not being retired. It is being built on. Across 2025 and 2026, insurers moved AI and machine learning underwriting systems out of pilot programs and into production, and trade coverage now describes 2026 as the year algorithmic underwriting became operational reality. Those systems sit layered on top of the credit-based scoring foundation rather than replacing it, which makes the 33-year-old correlation model the base layer of the new stack. The regulators are only now arriving. New York's Department of Financial Services issued a directive in 2024, Circular Letter 2024-7, requiring insurers to demonstrate that AI and external data systems used in underwriting do not act as proxies for protected classes. That was the first serious state attempt to govern the algorithmic layer, and it arrived 31 years after the underlying practice began. Across the Atlantic, the European Union's AI Act now classifies AI underwriting for life and health insurance as high risk, with mandatory bias testing and technical documentation in force as of this month, August 2026. Property insurance, the category that prices your home, is not on the high-risk list. Even the most aggressive AI regulation on Earth stops at the homeowner's front door. And in American state houses, the original fight is still live. As of this spring, bills to ban or restrict credit-based insurance scores sat pending in Iowa, New York, Oklahoma, and Pennsylvania. The same state-by-state battlefield the practice has occupied since the 1990s, now 4 fronts at a time, against an industry making the same argument in each one. 2 identical houses on the same street still carry different premiums. The variable is still not the roof. The score that separates them was filed in 1993, approved by omission, studied once, and never unwound. The new systems pricing your policy are being built on top of it right now.